A 71-year-old woman in Florida gave her daughter $80,000 to help with a down payment on a house. 2 years later, she had a stroke. She applied for Medicaid to cover her nursing home care. $9,400 a month. Medicaid denied her. Not because she was too wealthy, because of a gift she made 24 months earlier that she thought was completely legal. She spent down her remaining savings, sold personal property, and still spent 7 months waiting in a facility that cost her $65,800 she couldn't afford. That $80,000 act of generosity nearly wiped out everything she had left. Here's what nobody told her, and what nobody is telling you about how Medicaid actually works when you need long-term care. There's a rule buried inside federal law that most financial advisors never mention until it's too late. It's called the Medicaid look-back period. And right now, if you've given money to your kids, donated to your grandchildren's college funds, helped pay off someone's debt, or transferred anything of value out of your name in the last 5 years, you may have already set a clock ticking against you. You just don't know it yet. By the end of this, you're going to understand exactly how this trap works, what triggers it, what the penalty actually looks like in dollars, and, critically, 3 legal ways that people right now are protecting their assets without triggering a single day of penalty. Stay with me, because the difference between knowing this and not knowing it is the difference between leaving something to your family and leaving them nothing at all. Let's start with the basics, because most people misunderstand what Medicaid is for in the first place. Medicare, the program you paid into your whole working life, does not cover long-term nursing home care beyond 100 days. That's it. 100 days and the clock stops. After that, you're paying out of pocket. The average cost of a private room in a skilled nursing facility in the United States right now is $9,733 per month. That's $116,796 a year. Most people run through their life savings in under 2 years. Medicaid steps in when you're broke enough to qualify. The federal income limit for Medicaid long-term care in most states is $2,742 per month in 2025. Your countable assets, checking accounts, savings, investment accounts, most property, generally can't exceed $2,000. In some states, it's $3,000 for a married couple. So the system is designed to kick in only after you've spent nearly everything you have. And if you try to protect what you've built by moving money out of your name before applying, that's where the look-back period comes in. Here's how it works in cold, mechanical terms. When you apply for Medicaid long-term care, the state doesn't just look at what you own today. They pull 5 years of your financial history, bank statements, tax returns, transfer records. They're looking for any asset you transferred, gave away, sold below market value, or moved into someone else's name in the 60 months before your application date. That window is the look-back period. Every dollar you gave away during that window gets calculated into something called a penalty period. The state takes the total value of disqualifying transfers and divides it by the average daily cost of nursing home care in your state. The result is the number of days Medicaid will refuse to pay for your care, even if you have no money left. Let me make that concrete. In Ohio, the average daily nursing home rate used for penalty calculations is approximately $296. Frank, a 68-year-old from Dayton, transferred $45,000 to his daughter in 2022 to help pay off her student loans. In 2024, Frank suffered a major fall and needed full-time nursing care. His remaining assets had dropped below $2,000. He applied for Medicaid. The caseworker pulled his bank records and flagged the $45,000 transfer. They divided $45,000 by $296. That's 152 days of ineligibility, 5 months during which Medicaid would pay nothing. Frank had nothing, and someone still had to pay $9,000 a month for his care. His daughter returned the money, and it still took weeks of documentation and appeals to resolve. That's the trap. It doesn't care why you gave the money away. It doesn't care that it was a gift for a grandchild's education, a loan you never expected back, or a charitable donation to your church. The rule treats every dollar that left your hands in the last 5 years as a potential disqualifying transfer. And here's the part that keeps elder law attorneys busy year-round. The rule has no minimum threshold in most states. A $500 birthday check to your grandson could technically be reviewed. Most caseworkers focus on larger transfers, but you are not protected by the absence of a rule about small amounts. Now let me plant something in your mind that we're going to come back to. There are specific types of transfers that are completely exempt from the look-back. The law carves them out explicitly. Knowing which transfers are protected changes everything about how you plan. But first, you need to understand one more piece of the trap that almost nobody talks about. The look-back penalty doesn't start when you made the transfer. It starts when you apply for Medicaid and would otherwise be eligible, meaning you're already broke. So imagine this sequence. You give your daughter $80,000 in January 2022. You have a health crisis in December 2026. You spend down your savings. In June 2027, you apply for Medicaid with $1,800 to your name and a $9,400 monthly nursing home bill. Medicaid calculates an 8-month penalty period. That means for 8 months, starting June 2027, Medicaid won't pay a dime. But you're already out of money. Your family either covers the bill or the nursing home pursues discharge. This is not theoretical. Medicaid disenrollment for penalty periods is one of the most common crises elder law attorneys handle. Now here's what you can actually do about it. 3 strategies, each legal, each widely used, each with real structural protections. The first is the Medicaid Asset Protection Trust, sometimes called a MAP-TT. This is an irrevocable trust you create and fund with your assets, typically your home, savings accounts, or investment accounts. Once assets go into this trust, they're no longer in your name. They're managed by a trustee, often a trusted adult child, and you give up direct control. Here's the key. If you fund the MAP-T more than 5 years before you apply for Medicaid, those assets are fully protected. They won't count against you. They won't trigger a penalty. Eleanor, a 69-year-old widow from suburban Philadelphia, set up a MAP-T in 2019 and transferred her $340,000 home into it. Her son served as trustee. She continued living in the house. In 2025, she developed Parkinson's disease and required memory care. When she applied for Medicaid, her home was not a countable asset. It was in the trust. The trust was more than 5 years old. Medicaid approved her. Her son inherited the home without it being consumed by care costs. The catch? You must live for 5 years after funding the trust. If you fund it and need care within that 5-year window, you're inside the look-back period and penalties apply to the amount transferred in, which is why starting early matters enormously. If you're 67 right now and in reasonable health, a MAP-T funded today could be fully protected by age 72. Waiting until you're sick is waiting until the door is already closing. The second strategy involves what are called exempt transfers, the legal carve-outs I mentioned earlier. Federal law under 42 U.S.C. Section 1396P explicitly protects certain transfers from look-back scrutiny. These include transfers to a spouse, transfers to a child who is blind or permanently disabled, transfers of your home to a sibling who has an equity interest in the home and has lived there for at least 1 year before you entered a nursing facility. And this one catches people off guard. Transfers of your home to an adult child who lived in the home and provided care to you for at least 2 years immediately before you entered a nursing home, and whose care demonstrably delayed your need for facility care. That last one is significant. If your son or daughter moved in with you, provided personal care, and you can document that their presence kept you out of a nursing home for at least 2 years, you may be able to transfer the house to them after you enter care with no Medicaid penalty at all. The documentation requirements are strict: physician statements, care logs, records of caregiving activity. But the exemption is real, and it's used successfully thousands of times a year across the country. The third strategy is a technique called the Medicaid-compliant annuity, and it's particularly powerful for married couples. Here's the scenario. Husband enters a nursing home. Wife, called the community spouse under Medicaid law, still lives at home. Medicaid allows the community spouse to retain a certain amount of assets. In 2025, up to $154,140 in most states. But what happens to assets above that threshold? Without planning, they must be spent down before Medicaid pays anything. A Medicaid-compliant annuity converts a lump sum of excess assets into an income stream paid to the community spouse. The annuity must be irrevocable, non-transferable, actuarially sound, and have no cash surrender value. When structured correctly, the excess asset becomes income, which is treated differently than a countable asset, and the institutionalized spouse qualifies for Medicaid much faster. Here's a real-world illustration. Margaret and Harold lived in Tennessee. Harold needed memory care. Together, they had $280,000 in savings. The Medicaid resource limit for Margaret was $137,400. That left roughly $142,600 in excess assets that would normally be spent down on Harold's care before Medicaid engaged. Their elder law attorney helped Margaret purchase a Medicaid-compliant annuity for $142,600. The annuity paid her roughly $3,800 a month for just over 3 years. Harold qualified for Medicaid immediately. The annuity payments were income, not assets, so Margaret kept receiving them throughout Harold's care. The couple preserved more than 4 months of Harold's care costs, approximately $37,000 that would otherwise have been spent down. Now here's something most people miss. Even if you're already inside the look-back window, even if you made transfers in the last 5 years, you're not automatically locked out of planning. You can sometimes cure a penalty by having the transferred assets returned. If your daughter returns the $45,000 Frank gave her and it's returned in a documented, traceable way, many states will reduce or eliminate the penalty period. It's not guaranteed, and the rules vary by state, but it's a real option that elder law attorneys negotiate regularly. You can also sometimes use a promissory note, a formal loan documented between family members with interest, a repayment schedule, and equal payments to restructure a transfer that might otherwise be penalized. The key is documentation and proper structure. A handshake loan written on a napkin won't protect you. A properly structured promissory note that meets your state's Medicaid requirements sometimes will. The most important takeaway from everything I've just told you is this. Medicaid planning is time-sensitive in a way that almost nothing else in retirement is. The look-back clock starts when you transfer money, not when you need care. If you wait until your health forces your hand, your options narrow dramatically. The strategies that work, the MAPT, the caregiver child exemption, the spousal annuity, all require either time, documentation, or advanced structuring. None of them work well when you're filing the Medicaid application in a hospital waiting room. The other thing I need you to hear is that this is not something to handle with a generic financial planner. You need an elder law attorney who practices in your specific state. Medicaid rules are set at the federal level in broad strokes, but administered by each state individually. The penalty divisor in Tennessee is different from Ohio, which is different from California. The Community Spouse Resource Allowance changes every year. Some states have hardship exceptions. Others don't. What worked for your neighbor in 2020 may not apply to you in 2026. Remember that woman in Florida from the beginning? The one who gave her daughter $80,000 and then had a stroke. Here's what she didn't know. If she had structured that gift as a documented loan with a repayment schedule, and if she had consulted an elder law attorney before she transferred a dollar, she may have had options. Not guaranteed. Not painless. But options. The trap didn't have to be the end of her story. It became the end of her story because nobody told her the trap existed. You know now. If you've made transfers in the last 5 years, gifted money to family, or helped a grandchild with college costs, write down the dates and amounts and bring them to an elder law attorney for a look-back analysis. If you haven't made transfers but you have a home, savings above $2,000, or a spouse still living at home, ask that same attorney about a MAPT or spousal planning strategies today. Not after a diagnosis, today. The 5-year clock only works in your favor if you started running. Tell me in the comments, have you or someone you know run into the Medicaid look-back rule? Did it catch you off guard, or were you prepared? I read every comment on this channel, and I want to know what you're actually dealing with out there. If this helped you understand something that felt murky before, do me a favor and share it with a spouse, a sibling, an adult child who needs to understand this alongside you. And if you're not subscribed yet, the next video covers the Medicare surcharge most people discover only when it's too late to avoid it. You don't want to miss that one.